My name is Tom Fish. I'm Executive Managing Director with JLL, and I help lead our real estate capital markets finance practice based in Houston, Texas. Obviously, the banks are our primary construction lending source. That has been curtailed quite a bit in the last year. They also have a place in the shorter-term standing loan space. The life companies are always there to do mostly the long-term fixed rate and some floating rate transactions, mostly the higher quality transactions in the major markets. CMBS is a vital provider to the rest of the space, to some of the smaller markets, to some of the properties that maybe don't meet the criteria for the life companies. And then certainly the GSE, the government agencies, are our primary multifamily lenders who are did $100+ billion of multifamily loans last year and are the real catalyst behind why multifamily continues to be a leader in terms of valuation and liquidity in the marketplace. What banks are doing right now in the construction lending environment, they've gotten much more conservative with respect to their loan to cost. They've gotten a little pricier, as you would imagine, in a constrained market, and it's having an impact on slowing things down, and that's probably ultimately good for extending our cycle. We began our climb out of the financial crisis in the third quarter of 2010, and we've had a good, long, slow, steady run of success. And what it tells me is the liquidity and the resilience of the real estate debt markets is very sound. We've had blips along the way that reprice and keep the market in balance, and I think that's good. But the one thing that we look at more than anything else is just the liquidity that's in the marketplace. If something drastic happens, or some other unforeseen event that would curtail that liquidity, that would the other threat, frankly, that we have is if we have continued rising long-term rates, that creates higher alternative yields in other investments, and that might pose just a competitive threat to the capital that is seeking that return in real estate right now. So right now the tide is coming in. The tide is, we think the tide will still come in. If we go on a long hike in long-term rates, then that poses a certain concern to us. There's going to be a change in the number of players out there in the CMBS marketplace. That market seems to be much more competitive. It seems to be the risk retention rules that are in place right now, I think, will reduce the number of players currently in the marketplace. Everybody's wondering where that wall is because they're not feeling it in the pipelines. I think pipelines are good, but they're not to the level that it would suggest by just looking at the bar graph of maturities. And a lot of those maturities have already been refinanced and recapitalized. A lot of them are going to be requiring additional capital because a lot of what's left over couldn't be recapitalized along the way, and so they're going to need to be new equity infused or some other way of getting out. So I do think the rest of the year is going to be very interesting to see how that high point in the bar graph manifests itself in the marketplace.